Hello, everyone. Welcome to Accounting Focus. My name is Richmond, a young chartered accountant. Here at Accounting Focus, we lay down the principles in relation to international financial reporting standards because we believe, without standards, you can't even prepare a well-comprehensive financial statement. Are you with me? Good. And then after, we also solve past questions from IC, ACC, and Cima. Now, this channel is not just for students, but it's also very good for professionals as well who wants to quickly have a recap of what the standard is about. I'll be with me. Now, for today's episode, we are focusing on question solving on IFRS 16, subsequent measurement. Now, if you've not watched my previous videos where I lay down the principles on the IFRS 16 and then also solve questions on initial measurement, there will be a link below this video for you to have a quick recap. But then, if this is your first time watching as well, now what I will do is that even though we are solving questions, I'll make a quick recap on what the principles about subsequent measurements is about before we start a question solving so that you appreciate it more. Okay. So to begin with, now when you talk about subsequent measurements, let's have the understanding. Okay. Let's have the understanding. Now, in year one, you bought an asset. When you buy an asset and record it in the year one, we are going to use the initial measurement, right? Initial measurement. But then, after year one, you have to adopt. So if you go to year two, you have to adopt a model which you use in valuing your assets. Are you with me? And this is where we talk about the cost model. This is where we talk about the cost model and then the revaluation model. Now, when you talk about cost model is very straightforward here, okay? Now, when you talk about cost model simply says that if you take the cost of the asset, any form of depreciation, any form of impairment loss, subtract it from it for you to arrive at the carrying amount. Are you with me? Good. Now, when you talk about revaluation model, which is, the focus for today. Today, our question is on revaluation model. So get an understanding so that when you are solving a question, you appreciate it, okay? Now, when you talk about revaluation model, what we are saying is that you have a value in your books. But this value you have in your books, let's say you have a value of 10,000. Let's say you have a value of 10,000 in your books. But when you go to the market, the fair value of that particular asset is like, let's say 15,000. Will you still maintain the value of 10,000 in your books as cost of the asset? No. We have to change the cost from 10,000 to 15,000. But it's not that straightforward. Before you be able to revalue your asset, you need a revaluation analyst, a specialist who has knowledge in that field to do that. I hope you are getting me. Good. So in changing from 10,000 to 15,000, it brings about what we call a revaluation gain or loss. I hope you are getting, which I spoke about in the previous videos. But then you are still safe here. Good. Now we are saying that after you revalue this asset to 15,000, any form of depreciation, subtract it, and any form of impairment loss, subtract it. Are you with me? Okay. Now we are saying that it's not like every year you should be doing this revaluation. No. The revaluation could be done every 3 to 5 years, every 3 or 5 years. So every 3 or 5 years, you can check the market value of that particular asset and see if revaluation is needed to be done. Are you with me? All right. Now, when you talk about the revaluation model, you are saying that it leads to an increase or decrease. It leads to an increase or decrease in your carrying amount. How does it lead to an increase or decrease in the carrying amount? That is the question. The value, let's take the same example. The value of the asset, so the carrying amount. And because I explained carrying amount in the previous video, I believe we all understand what carrying amount is. So carrying amount in your books is like 10,000. Now, the revalued amount or the revaluation, the new value you have to give to your assets, revaluation amount is like 15,000. Okay. Now you realize that the cost of the assets if you should revalue it to 15,000, the cost of the asset has increased by 5,000. Are you getting the principle? Now, this 5,000 here has added up to the cost of the asset. So as it has added up to the cost of the asset, as it has added up, what it means is that there was a debit, right? So the question is, where should the corresponding credit entry, because you know that in accounting, every debit entry must have a corresponding credit entry. Is that not it? Now we are saying that this credit entry must be recorded under equity as revaluation surplus here. This is it. Now, this same principle says that assuming that particular asset has already been impaired during the period that the revaluation occurred, assuming this particular asset has already been impaired. Now, even when you are getting a revaluation gain, the corresponding credit entry should not go to your equity as revaluation surplus. No, we should hit that credit entry to our P&L account so that it will reduce the impairment loss. Because if there has already been an impairment loss, what it means is that the impairment loss will be debited to the account, right? It's an expense. It will be an expense. So it will be treated as an expense under the P&L account, right? But then if there is already an impairment loss, credit it to your income statement so that it balances it off. It reduces the balance of the loss. It reduces the impairment loss. Are you getting the picture? Are you getting the picture? Good. Now, let's go on. When there is a decrease, so this is the case where your current amount is 10,000, but then the revalued amount is 8,000. You realize that this is a revaluation loss, right? It's a loss. So what we are saying is that it means you are losing on the cost of the assets because you have 10,000 in your books, and right now you are reducing it to what? To 8,000. So if you are reducing it to 8,000, now what it means is that the 2,000 becomes a loss. We are saying that debit it to your expenses in P&L account as revaluation loss. Just debit it, straightforward. But if there is already a credit balance in the revaluation surplus, what I'm saying is that if this asset, okay, has been revalued before, there is a gain in the revaluation surplus under equity. What you are saying is that debit it to equity, because equity has a credit balance, right? So when you debit it, it reduces the what? The amount of what? The revaluation gain under the revaluation surplus account in equity. Are you getting the principle? So this is like a very general principle. Let's move on to the question for today so that we put these principles into practice. Then you appreciate it very well, okay? So to start with, you are saying that Crunch Limited revalued its buildings and decided to incorporate the revaluation into the books of accounts. The following is relevant. Extra from the balance sheet as at 31st December 2017. Buildings depreciation has been provided. Depreciation has been provided at 2% per annum on straight line basis. 2%. That's the depreciation rate. The buildings were revalued on 30th June 2018. This is very important. Now, anytime you are solving accounting questions, look out for the dates. At $5,520 million, there's no change in this remaining estimated future life. Okay, required. Show the relevant extract for 2018 financial statement. So I told you dates are really relevant. Is that not it? So let's focus. Now, let me give you one trick. Anytime. So what it means is that before this question came to revaluation, what it means is that the company adopted a cost model where they only have the cost, then they will be subtracting depreciation. As you can see, depreciation is 1,800. As at 31st December 2017, depreciation has already been calculated for a number of years. We don't know those number of years, right? But then they've given us the bulk figure. They've given us the actual cost because they said depreciation is on straight line basis. Anytime depreciation is on straight line basis, we apply the rate on the cost of the asset. The rate of 2% on the cost of the assets. I hope you are getting me. So now, let's make this question solving interesting. Now, one trick. So first of all, even though we are solving questions on subsequent measurements IAS 16, I also teach you how to solve questions, right? It's very important. So Crunch Limited, right? The name of the company, Crunch Limited. Now, immediately you hear about revaluation, the asset has been revalued. the first thing you should focus on, don't even consider the revalued amount. The first thing you should focus on is getting the carrying amount. Very simple. So we are going to make this question solving very simple. Okay. So focus on carrying amount as at. So when did the revaluation happen? It happened on 30th June 2018. You want to get the carrying amount as at 30th June 2018. As at 30th June 2018. But they've given us the cost of the assets as at 31st December 2017. Do you agree that if it is 31st, the cost of the assets, so they've given this, right? They know that this is the cost, this is the total depreciation as at this date. What it means is that the carrying amount as at this particular date will be the cost minus depreciation, cost model. Do you agree? Yes. And I know you are appreciating it. All right. So you know that this 31st December 2018 is the same as me saying 1st January 2018. You agree? Okay, let's take it. So carrying amount as at 31st December 2017. That will be the cost here, which is what? 6,000, right? Then the total depreciation here, it has already been calculated, right? Which is what? 1,800. I hope you are having your calculator with you. Here's my calculator. So 6,000. So solve it with me. 6,000 minus 1,800. If you have any question, drop it in the comment box, okay? So we are having 4,200. So this is the carrying amount as at December 31, 2017. But when did the revaluation happen? It happened in 30th June 2018. So from 2017, December 31st, 2017, where do you go? You go to 1st January 2018, right? So 1st January 2018, so from January to June, 30th June, what it means is that you continue using the asset from January to June, and then before you revalued it. What it means is that when you are calculating depreciation, the depreciation on monthly basis will start from January up to June, right? So we want to calculate the depreciation. So depreciation here would be we know it's calculated on what? On cost. So 2% here times our 6,000. How many months do we have in a year? We have 12 months. Is that not it? But from January to June will be 6 months. So it means that it will be 6 over what? 12. I get it, because January, February, March, April, May, June. So that's 6 months. So we are going to calculate 2% times 6,000 times 6 over what? 12. So that gives us 60. So what it means is that we will subtract only 60 and we will not calculate full year depreciation, right? So 4,200 minus 60, that's going to give us 4,140. So this gives us carrying what amount as at the date of revaluation. So as at June 30th, 2018. Are you appreciating the concept? Good. Now, we established the understanding that anytime there is revaluation, it results in what we call a revaluation gain or loss. If the revaluation amount is more than the carrying amount, the revaluation amount is more than what you have in your books, it results in a gain. But if the revalued amount is less than the carrying amount, then it results in a what? A revaluation loss. You agree? Good. Now, let's continue. So what is the revalued amount? The revalued amount is now what? 5,520. 5,520. So we are going to have, so let me write revaluation gain / loss. And you know why? If it's a loss, it means that it will subtract from this, right? So that if it's a gain, it will add up. So revaluation gain. So revalued amount over here. So what's the revalued amount? It is 5,520. So if there is an increase, it means that it's a gain. Is that not it? But if it's a loss, if there is a decrease, it means that it's a loss. Are you appreciating the concept? So Obviously, the revalued amount is more. So what's the difference? 5520 minus 4140. That is 1380. 1380. So when you add this to this, you realize that you get 5,520. So this was the amount in the books as at 30th June 2018, which is 4140. Is that not it? Then when as at the same date, they are saying that the market value, the revalued amount, okay, was 5,520. Obviously, there is an increase. Now, what did we say about it? We are saying, so what it means is that this revalued amount will be what will show in the books now. That's the actual cost of the assets now. I hope you are getting me. As at 30th June 2018. This here, this 1,380 becomes the revaluation gain. And what did we learn about the revaluation gain? The debit has already been made. So where should the corresponding credit entry go? The corresponding credit entry should hit the equity, right? As revaluation surplus or revaluation reserve. But this is the case, we also have to find out whether there has already been an impairment loss. There is no impairment loss, so our treatment is right. Is that not it? Okay, so let me start from here. So statement of. So now, statement of profits or loss account. But before that, now they said we should show the relevant extract for 2018 financial statements. What it means is that for the whole of the period, is that not it? So we are not yet done. Now, after this asset has been revalued, this is what you have to know. So this asset has been revalued, right? As it has been revalued, it has been given a new cost. What it means is that the useful life, we also have to look at the useful life. So in terms of the useful life, so useful life has to do with how long the asset has been, how long we can use the asset. Is that not it? So let's focus on getting the useful life. So useful life. Now, the rate was 2%. Is that not it? Now, we assume that the useful life in terms of percentage is 20%. So if we want the useful life in terms of, years, so we are saying that total useful life should be equal to our 100% divided by the 2%. This will give us 50. So that will be 50 years. Are you with me? All right. So this is 50 years. Okay. Now we are going to look at, so this is total useful life. That will be 50 years. Now we are looking at expired useful life. Okay. So 50 years. So let's look at our expired useful years. So let's look at expired useful years. Expired useful life. We already have 1,800, right? We already have 1,800 as, the depreciation that was calculated. Is that not it? So what it means is that if you are able to get the when you're able to get the depreciation, so 1,800 was the depreciation that was calculated and is given to us. Now, what it means is that when you're able to get depreciation for a year, they will be able to know the number of useful life that has been calculated. So to get a depreciation for a year, that is 2% times 6,000, which I believe it will give you 1,000. It will give you 120. So 2% times 6,000, that will give you 120. Good. So what it means is that 1,800 divided by 2%, divided by 120, that will give us 15, right? But don't forget that this 1,800 was as at 1st December 2017. So you also have to add this one, this amount that was calculated here. I hope you are getting it. Depreciation was calculated before the revaluation. Depreciation was calculated for 6 months. So in terms of, fraction, it will be 0.5. Is that not it? So 0.5. So we are going to have, so the expired useful life is going to give us 15.5 years. So if you are going to get the unexpired useful life, that will be what? 50 minus 15.5. And that is 34.5. Now, this is what we are saying. Why are we calculating the unexpired useful life or the remaining useful life? This is remaining unexpired or remaining useful life. Why are we calculating it? We are calculating it because the asset was in our books, and we are saying that this asset, the useful life of the asset is 50 years. Is that not it? But we've been able to calculate depreciation. We've been able to use the asset for 15.5 years. And we revalue the assets. Now, when you revalue the assets, you've given it a new cost. Do you still have to use the same useful life? No. So let's look at the depreciation that we've calculated. Let's look at the useful life that this asset has been able to service up to. Take it away from the total one and then get the remaining one. Because when you read the question told you that there is no change in its remaining estimated useful life. Assuming something was changed, assuming it was changed, this calculation would have been different. Are you getting it? So what it means is that if you also want to calculate the depreciation, for, let's say, from June 2018, right, to December 2018, because we are doing it for the whole year, but some part of June it was we're using the cost model, and then from June to December we are using the revaluation model. Is that not it? But now this June was as at 30th June. So what it means is that the calculation will be from 1st July to December 2018. Are you getting the principle? All right. So what it means is that we are going to take the cost. So what is the cost? The cost is now the 520, right? Then we divide it by what? The remaining useful life, which is 34.5. But do we have to calculate full year depreciation? No, we have to calculate the remaining useful life. So from July to December, July, August, September, October, November, December. So that's 6 months. So 6 over what? 12. So we end up getting 5520 all over 34.5 times 6 over 12. So this gives us 80. Are you with me? All right. So now, if this is giving us 80, right now we can finalize it because we are done. Is that not it? So let's take our statement of comprehensive income. Now, in this one, we'll have our depreciation. This is profit and loss account, right? So the depreciation. Now, the question is for 2018. Is that not it? This is for 2018. So the depreciation. What depreciation were calculated in 2018? This 80. Do you agree? So 80. We are looking at for the whole year, not when the revaluation happened, for the whole year. So the depreciation will be 80 plus the 60, which was calculated under the cost model. Do you agree? So you have 140 here. Now there was a gain. So OCI, you record the revaluation gain under OCI. So revaluation gain under OCI. So the revaluation gain was 1,380, right? Now let's look at the statement of financial position. Now, when you take the statement of financial position, we'll start with the non-current assets. Is that not it? So the non-current assets here, we have building. Or was it not building? Yeah, the building. So building. So you can as well say PPE or building. So the cost of the building that we will show in this book here, so that will be PPE, or the building will be the 5520, right, minus the 80. Do you agree? Because the 5520 was the revalued amount, and the new depreciation on it was what? The 80. So the current amount as at 31st December, 2018 will be the 5520 minus 80. So that gives us 5440. Are you with me? Then under equity, the revaluation reserve. Do you remember? So our revaluation reserve would be what? 1380. So this is how we deal with it. Are you with me? So this will bring us to the end of our question solving on this particular question. I'm going to solve another question on the revaluation so that you see how other questions will come, the form in which other questions will also come. Are you with me? So if you appreciate this video, like the video for me, share with your friends. If you have any question, put it in the comment box. I'll address with another video. Bye.